I'm Jeff Baskies, an attorney with Katz Baskies LLC in Boca Raton, Florida, and with me is Marjorie Horwin, the CPA partner in charge of the Palm Beach practice for Morrison, Brown, Argiz Farra, also in Boca Raton. We've been asked by the Community Foundation for Palm Beach and Martin counties to discuss the new rules related to converting traditional IRAs to Roth IRAs and possibly converting them back again. Marjorie, could you briefly explain for us what a Roth IRA is?
A Roth IRA was created by the Taxpayer Relief Act of 1997. Roth IRAs are unique retirement accounts. Unlike traditional IRAs, where money goes in tax-free and is taxable when it comes out, Roth contributions are not deductible, but withdrawals are not taxable.
Marjorie, can you tell us when withdrawals are tax-free?
Qualified distributions from Roths are not subject to federal or state income tax. Distributions are qualified if they are made 5 years after the contribution.
Also, don't Roths have special benefits regarding estate planning and tax deferral compared to traditional IRAs?
Yes, required minimum distributions that apply to IRAs do not apply to Roth owners. That means a Roth owner who does not need distributions can allow those funds to stay inside the Roth for the rest of his or her life. And it will grow greater tax-free growth compared to a traditional IRA, where the owner must withdraw at age 70 and a half or the year following age 70 and a half.
Now, Marjorie, when a Roth IRA owner dies, can the named beneficiaries continue this tax deferral?
Yes, they can, but only partially. The beneficiaries of the Roth don't have to withdraw the funds when the owner dies. They do, however, have to take the distributions over their life expectancy,
which gives added tax deferral and clearly another benefit. Now, Marjorie, can clients with traditional IRAs convert them to Roth IRAs?
Yes, they can. Prior to 2010, however, only clients with net income below $100,000 of modified adjusted gross income could convert. The big change in 2010 is that clients with net income in excess of $100,000 can convert now.
Now, what are the tax consequences of converting, Marjorie?
Clients who convert from traditional IRAs to Roth IRAs will have to pay the tax for the year of conversion. That means paying the income tax currently instead of deferring the income tax as the traditional IRA would be paid out.
So what are some of the costs and benefits for clients considering a conversion to a Roth IRA?
First, everyone must realize that the conversion to a Roth generates current income taxation. That means a large income tax payment now in exchange for avoiding a series of smaller income tax payments in the future. For some taxpayers, this is potentially very valuable. If they have enough money in their accounts to pay the tax from separate assets, that means they can leave the Roth 100% to grow tax-free. From a purely mathematical standpoint, that would leave with them greater wealth in the long term inside a tax-free vehicle. And from an estate planning perspective, the conversion allows clients who don't need the RMDs to leave more money in the IRA for retirement or to beneficiaries. Again, that should mean more wealth to the family.
Marjorie, now that we have a basic overview of how a Roth IRA works and how it differs from a traditional IRA, can you help explain why so many clients and advisors are talking about the conversion to Roth IRAs this year?
Well, Jeff, the Tax Increase Prevention and Reconciliation Act that President Bush signed back in 2006 made significant changes surrounding the rules around IRAs in the year 2010, specifically Roth IRAs. Income limitations on conversions are removed so that anyone can convert an existing traditional IRA or other retirement plans, meaning 401ks, SEPs, 403b plans, beginning January 1, 2010. Prior to 2010, if your modified adjusted gross income exceeded, as we said, $100,000, you couldn't make the conversion. If you convert in 2010, you have the ability to recognize half of the income in the tax year 2011 and the other 50% in the tax year 2012, or you can report all of the income in 2010 and pay the tax April 15th of 2011.
Now, Marjorie, I've heard some advisors suggest that spreading the tax out in the years 2011 and 2012 might actually be a bad idea. Can you comment on that?
Well, it's all a game of where tax rates go. Under the current administration, we're assuming that tax rates will increase to 39.6 in tax years 2011 and 2012. Now, with tax rates in 2010 at 35%, it may make sense to pay that Roth IRA in 2010 at a lower tax rate.
Excellent. And when do we have to make the decision as to whether to recognize the income in the year 2010 or to spread it out over the years 2011 and 2012?
You have until October 15th of the year following, which would be October 15th, 2011, or when you file your tax return, you have to make that decision.
So for a client who converts today, for example, they can postpone the decision about whether or not to recognize the income in this tax year or spread it out over the later two until as far as October 15th of 2011. Is that correct?
That's correct. And we've done some calculations and learned if you convert in 2010, it probably is most beneficial. Converting in 2011 and 12 would mean that you would need to generate income at 9.5% to pay the higher tax rate.
I wish I could earn 9.5%, Marjorie.
There you go.
Now, so that gives the client the benefit of making an informed decision probably next year when we'll have a better idea what the tax rates will be because they don't have to make the decision until next October. Now, speaking of making informed decisions, I'm told that clients who convert to Roth IRAs can change their minds, Marjorie, and reconvert back to traditional IRAs. Can you tell us more about reconverting?
That's correct. One reason is maybe that your portfolio has declined since you've made the conversion. As a result, you paid a tax liability on an amount that maybe is no longer in your portfolio. So if your assets are down, you may want to convert back to a traditional IRA and not pay the tax, and then try converting at a later date.
Now, Marjorie, when does that decision have to be made?
Well, you can do the reconversion by October 15th of 2011 for 2010 tax year, and then you could reconvert by January 1st of 2011.
Excellent. Now, some advisors have suggested that for clients with large IRAs, because of the potential to convert back to a traditional IRA if assets go down in value, that perhaps when they make the conversion, they should actually not make one conversion, but a series of conversions to multiple Roth IRA accounts where they segregate their assets. Would you comment on that technique?
I think that's very wise advice. By splitting your Roth into several separate Roths based on your investing technique in that particular bucket, you can then pick and choose which accounts you want to reconvert or let them continue to be Roths.
Well, it sounds like good advice for clients with enough money to justify having multiple Roth IRA accounts. Now, Marjorie, for some of the harder questions. Which clients, in your opinion, are good candidates to consider converting their traditional IRA accounts to Roth IRAs?
First, I think only the clients that should convert are those that can pay the tax from other funds. Plus, if you are 59 and a half and have to use your IRA funds to pay the tax, you would be subject to the 10% penalty. Second, it would seem that conversion only makes sense for clients who feel they don't really need to rely on the IRA funds for retirement. If clients will likely make withdrawals at the RMD or faster, then converting probably doesn't make sense. Third, I think clients who convert should also believe that they will be in the same, similar, or even higher tax brackets in retirement after considering the impact of withdrawals. For clients with huge IRAs, I know that their RMDs alone will put them in a higher bracket, so converting would make sense. But for clients who may be in a very low tax bracket in retirement, maybe paying taxes right now doesn't make sense.